Hi, I'm Jarrad Brown, Australian expat financial planner. Thanks for tuning into my video today. What I'd like to share with you are some investor insights, some tips, some takeaway lessons from the recent collapse of the FTX cryptocurrency exchange. Now, it's important to realize that very real people lost some very real money here. So this video is not about having a go at cryptocurrency or the technology that sits behind it, but rather what we as investors and as professional money managers we can actually take away as insights. So in this video, we're going to have a look at what happened, why it happened, and what some of the key lessons are. So let's dive right in. So first and foremost, if you haven't heard of FTX or the CEO, Sam Bankman-Fried, a very brief background. Sam set up the company in 2018, fully launched in 2019, and by 2021, this was one of the largest, it was actually the third largest in terms of revenue and trade volume, cryptocurrency exchanges in existence. In its peak in 2021, the company was valued at about $32 billion, putting Sam's net worth at around $16 billion. That's when this started receiving a lot of attention through 2020 and 2021. And then came the collapse in 2022. Now, the company itself allowed for the trade of risky leveraged options right down to your basic cryptocurrency trades from US dollars to Bitcoin, for example. So there were a lot of options here. Now, some of the issues, some of the allegations that have been made are that Sam was using client funds within FTX, within the exchange, to basically fund another company that he controlled, Alameda Research, which was basically carrying out a lot of risky trades in the cryptocurrency space. We'll get into exactly what happened and what transpired, but basically that gives you a bit of background of who FTX is and what actually has happened. Importantly, headquartered in the Bahamas. So an interesting point that I highlight there because that is one of the key lessons we need to be very mindful of when we're looking at different investment options. So let's have a look at what led to the collapse of this exchange. Now, this whole case is going through the courts at the moment. This will no doubt drag on for some time. There will be various appeals, I'm sure. So until all of this comes out, we're not going to know exactly what the root causes are and how much of it is true. But what we do know at the moment is that there were funds shifting from FTX to Alameda Research, that when there was a rush on funds, i.e. clients wanted to withdraw their money from FTX, there wasn't enough money to cover those withdrawals. So you might argue that the liabilities, being the funds owed to clients, were not actually covered by the company's assets. Now, they've alleged that there were enough funds, that there was a misunderstanding, poor bookkeeping. Again, the truth will come out. But a very important lesson when we do look at company reports is what are they actually doing with funds? If you consider a bank, for example, when they take on savings from investors, from individuals like you or I, what are they actually doing with that money? Are they lending it out? Are they making risky trades? How much of it do they actually need to keep on their balance sheet so that if one day there is a rush on funds and clients decide to withdraw their money, such as we saw in Greece in the financial crisis, that there is enough money there. Now, Alameda Research, Sam's other company that he had basically full control over, held about $5 billion of FTX's native token. Now, we're not going to get into the science, the technology, and all of the terms and technicalities of what tokens are, what cryptocurrencies are, but think of this simply as a credit or a form of currency that was used to cover some of the fees, the trading fees, the brokerage, the commissions, if you were trading from, for example, Bitcoin to US dollars or buying FTT, for example, FTX's native token. So you might argue that a lot of this was propped up by their own controlled company. The other issue was Binance, another significantly larger cryptocurrency exchange, held around $500 million of FTT, the native token. And what we saw early November was Binance came out and announced that they would be selling. That led to panic amongst investors, and that led to the liquidity crunch that ultimately led to FTX filing for bankruptcy in the second week of November. Investors wanted their money out, there wasn't enough money to give them, and ultimately bankruptcy was the result. So what can we take away as investors from this collapse, from this event that has transpired? Let's have a look. The first lesson, in the words of the great investor Warren Buffett, is to stay within your circle of competence. Now, by this I mean understand what you're investing in. There are far too many people throwing money, and often large amounts of money, at cryptocurrency, treating it a bit like the lottery and hoping that it's going to work, that it's going to pay off, with really no understanding of the technology, the business plan, the growth, the investment expectations, or particularly the risks associated with that investment. Now, it doesn't mean that you need to understand all of the minute details around the business, the technology. You don't need to know all of the iron processing processes if you're investing in BHP, for example, but at the very least, understand what you're investing in. And if you don't understand it, you probably shouldn't be investing in it. So that's lesson one. Lesson two is review your asset allocation. By this, I mean how much of your personal balance sheet, meaning your assets, take away your liabilities, is invested in the different assets. We have shares or equities, we have bonds, government bonds, corporate bonds, various other income producing assets, we have property or real estate, and we have cash. Within the growth space of this asset allocation, we also have the alternative assets, which is often where cryptocurrency will sit. Whilst a lot of people would argue that in some cases they are equities, often they have a lot of risks that are not always associated with equity investing. So when it comes to cryptocurrency, when it comes to alternative assets, be very mindful of how much of your balance sheet is exposed to that one asset class or to that one investment, for example. You may want to set a cap, that might be 5%, 10%, 50%, whatever is suitable for you, but keep an eye on your asset allocation and track it on a regular basis. At least once every year or two is a good rule of thumb. If you're in very volatile assets, you might want to review this a bit more regularly. So that's the other lesson that we need to be mindful of. Let's have a look at the rest. The next critical lesson is, if it sounds too good to be true, get up and walk away. There have been so many Ponzi schemes out there, so many promises of great returns. Anyone promising you a guaranteed return, in most cases of anything above a term deposit or a high interest cash account, is often lying or not disclosing all of the risks that are actually associated with that investment. So be very mindful of what you're being promised, make sure you understand the risks, and if you are considering some of these investment options, make sure you're asking the advisor or the salesperson that you're speaking to, what are the risks? How does this all go wrong? What would be the scenario? What events would need to take place for me to not get my money back or to get back less than I invested? Make sure you're comfortable with that risk, and if you are, then again, you can proceed accordingly if it's suitable for you. So that's the third lesson to be mindful of. The fourth critical lesson is to consider the location of the regulator. Is it even a regulated investment? Now, often with cryptocurrency or some of these alternative investment schemes that might only be marketed to accredited or wholesale investors, then in many cases, not all of the risks need to be disclosed. And in many cases, it's not regulated, not covered by the regulators in that country. If we look at FTX, for example, they were headquartered in Bahamas. Good luck going to the Bahamas and taking that through the courts. Now, it's not to say that all investments headquartered in the Bahamas are bad. It's just to say, make sure you're comfortable with the level of recourse that you have. Make sure you're comfortable with the regulatory oversight. If you need to make a complaint, if you need to check that this investment has actually been vetted by an authority, make sure you're comfortable with the authority in question. So they're the four critical lessons. I hope that sheds a bit of light on what's happened, what we can take away as investors. We look forward to the Netflix series on this one, which I'm sure will be in the not too distant future. If you have any questions at all, drop me a note in the comments, reach out to me directly. More than happy to hear from you. Please remember to subscribe, like the video, and I look forward to seeing you next time.